Okay, good morning, everyone. Thank you for being here this morning. We're here today to discuss all you need to know about transfer pricing in Mozambique. I will take you through the agenda briefly. We've got an hour and we'll try to make it as constructive as possible and as informative as possible. We will share the slides after the workshop, so thereafter you'll have the opportunity to raise any specific questions that you might have directly with us. So today we will give an introduction to transfer pricing, what is transfer pricing and what's happening globally with transfer pricing. We will also take a dive into the Mozambican transfer pricing rules and the transfer pricing documentation requirements. We'll also look quite specifically at the trends in Mozambique. What do we see happening on the ground there? Mozambique is one of the newest countries, certainly in Africa, to have brought in the rules. And it is just now at this stage that we're starting to see the tax authorities actually seek to monitor the implementation of the rules that were brought in. And we'll then wrap up and look at the wider considerations and next steps. So a brief introduction. I'm Cabrini McCarrick, the lead transfer pricing partner at Regan van Rooy. Regan van Rooy is a South African and Mauritian headquartered company. It's a boutique international tax transfer pricing and structuring firm established back in 2016. And from a transfer pricing side, we offer the full suite of transfer pricing services from your documentation to controversy management across Africa. I'm also here with Luis Cheveia, the head of tax at Milestone. And Luis, I'm going to hand over you briefly to introduce yourself. I'm sure you'll do a better job than I will.
Okay, thank you everyone for joining us in this webinar. My name is Luis Cheveia, the head of tax of Milestone. Milestone is a consulting services acting on management, financial, and tax and audit services. So Milestone is purely local company of consulting. Milestone has been in the market for the last 7 years, and the base of the foundation were the former Ernst & Young and Deloitte partners, leaders, and top managers, right? I think that's it.
Okay, thanks, Luis. For full transparency, Luis and I worked together at Deloitte back in South Africa during the
Yes,
day, but we're now older and grayer, and Luis is certainly more hairy on the beard, anyways. So it's nice to have you with us today, Luis.
yes. Actually, my first steps on the transfer pricing matters was with you, Cabrini, there at South Africa.
Indeed, indeed.
Yeah.
Um, okay, so what is transfer pricing? So the increased internationalization of business and the complexity of multinational groups, the heightened scrutiny of tax authorities regarding intergroup transactions has made transfer pricing one of the most important, critical, by the way, and controversial areas in tax and international business. Off the back of, you'll all have heard of this, the Base Erosion and Profit Shifting Project and various OECD updates, essentially a new spate of legislation was implemented globally. Particularly in Africa, which may have been a little bit behind, say, Europe in terms of implementing transfer pricing legislation. We've seen new legislation in the past 5 years in the vast majority of the African countries, and of course, including Mozambique, one of the ones that have issued relatively new legislation. So the world is looking for tax transparency. Essentially, they want to understand who pays tax where. And of course, we're talking about in the context of a group where there is more than one legal entity in the group, and how groups manage their tax with respect to their group activities. So transfer pricing is the cornerstone of international tax, and transfer pricing models are integral to where and what profits are realized. Transfer pricing is a tug of war between the tax authorities. Each tax jurisdiction essentially is wanting to ensure that they get their fair share of the tax base. And for example, that groups are not eroding the local tax base in Mozambique by shifting profits, for example, whether on purpose or not, to lower tax jurisdictions, or even just any other tax jurisdiction. The key focus of transfer pricing, as we mentioned, is on cross-border transactions between connected or associated persons, and whether or not these transactions can be considered arm's length. Arm's length, of course, is the standard where we simply say you must transact with your related party in the same way as if you were transacting with a third party. And if you do that, the pricing of those transactions can be considered arm's length. You can document it, and then you can show to your tax authority that you are compliant. In Mozambique, domestic transactions must also be considered. Domestic transactions is essentially an interesting one. There's a number of African countries that include domestic transactions in the context of the legislation. And it's often where there are local tax benefits for certain characteristics. For example, you pay a lower tax if you do certain manufacturing activities. So in that way, you can have the erosion of the tax base, but through your local or domestic group structure. Profit should follow value creation. Okay, so basically more profit should fall where there's more value added activities being performed. But obviously that's not an easy concept. The complexity in transfer pricing is determining where the value is in the supply chain so that you can try to figure this out. Transfer pricing is not a normal tax. It normally attracts lawyers and economists as well as accountants. It looks at supply chain. How does your business work? It is not just a number crunching exercise, probably unfortunately, because it probably would be more simple if it was. Okay, so the onus is on the taxpayer to prove that the related party transactions were concluded at arm's length. And this needs to be evidenced through various forms of documentation, financial data, legal agreements, functional and economic analysis. Luis will take you through transfer pricing documentation. Essentially, what's contained in the annual transfer pricing documentation that businesses are required to maintain in Mozambique are included these core components of a functional and economic analysis. It is quite detailed. It basically explains how does the transaction work between the related party, who does what, and it then looks to benchmark using independent comparable data, the pricing arrangements. So all of this information actually goes into your transfer pricing documentation that should be prepared annually. And the tax authority then reviews this and determines, okay, is it arm's length or not? Okay, all good, or no, they want to do an audit or ask more questions. A big focus on transfer pricing is around economic substance over legal form. And what that means is you can't just have a service agreement or an IP agreement that says all the IP is owned in Mauritius and we're going to pay royalties out for the use of that IP. And then that not match the functional or what happens on the ground. So to pay out an IP royalty, for example, you have to have the appropriate substance. So you have to show that the other party developed the IP, is responsible for enhancing the IP, protecting the IP. So you have to show that they're doing the functions and bearing the risks that makes them not just a low legal owner of the IP, but also the economic owner. Then the other thing that tax authorities look at very commonly is the significant people function. Who's doing what? So again, if you're paying a fee out to an international entity and there isn't a significant headcount in that entity, this can be a flag for the tax authority to say, well, who are you paying what for if you've got one or two individuals there and actually you've got 200 people on the ground in Mozambique who appear to be doing all the work. So they're looking at the people function as well as the functions to substantiate any outbound payments. This also, transfer pricing, of course, covers inbound payments to Mozambique. So that is, if Mozambique is providing any type of services or selling any goods to a cross-border related party or domestic, they will also analyze that side of the transaction. Transfer pricing is a two-sided analysis. So that's why there's the tug of war between the tax authorities often occurring. So there's a focus on the value chain and the key value drivers. So for doing your transfer pricing, you really need to understand how the business works. And that's why it's not just a tax or a finance function. Transfer pricing also normally goes up to the C-suite level, the executives in the business who really understand the commercial strategy of the business. And why does all this matter? Because the fact pattern and the economic realities underpin what amounts to an arm's length remuneration. And an arm's length remuneration at the end of the day is what the taxpayer has an onus to evidence to the tax authority each year. So to try and simplify all of this, I'm sure we have some TP experts on and some people who have less expertise. So what we're saying is we need to understand with the connected party transaction who does what. And then we need to understand what's the economic significance to the value chain of those activities. Then look at what's the remuneration, who gets paid what for these activities. And it's through that mechanism that we can determine what is arm's length or not. So transfer pricing is governed globally by the OECD guidelines. Mozambique is broadly aligned in terms of the documentation requirements, even though it's not a member of the OECD, similar to South Africa, for example. The TP rules also follow the approach of the UN Practical Manual on TP for developing countries. It is important that the rules around transfer pricing can be interpreted differently by different tax authorities. And sometimes they will rely on the OECD guidelines. Sometimes they will rely on specific regulations in the Mozambique or the local tax jurisdictions. And in some cases, they will refer to the UN Practical Manual. So when we do our documentation, we need to consider all of these sources of information to make sure that you've got a defendable position. Of course, local Mozambique specific rules must be considered, and that's quite critical to keep your local Mozambican tax authority satisfied. So who cares about transfer pricing? The tax authorities, of course, and the global regulatory bodies. So in terms of foreign exchange restrictions and things like that, you've got other regulatory bodies that care if your transfer pricing is up to speed. The tax authorities care because they want to make sure that if you're incurring a cost that you're paying to a related party and you're deducting it, that this deduction is appropriate, so that you're basically doing your accounts correct. And if you're providing a service or selling goods to a foreign party, that you're earning enough revenue on that, which translates into a profit on which you pay tax. So the tax authorities, of course, care. Taxpayers care. Why? Because you now have to deal with the compliance burden that the legislation has brought about. Luis will talk about that, but there's essentially two key things for Mozambican taxpayers: your annual transfer pricing documentation and your transfer pricing declaration. Your stakeholders. So transfer pricing often has negative how do we say, a negative view in the press and in politics, and it's often connected to moral implications. So there is this idea that, for example, large global multinationals seek to extract profits outside of Africa. So nobody wants to be put, you'll know about the Panama Papers now and these very high profile transfer pricing cases across the world. Nobody wants a bad reputation around transfer pricing. No one wants to be seen. It's now good to be a good boy or girl when it comes to being a compliant taxpayer. This kind of the old way of doing things, where it was clever to try to generally minimize tax and do risque things, is really in the past. So your stakeholders care because it impacts your reputation as a business, as a taxpayer, and how you do that. The public, just as we mentioned, there's reputational considerations around transfer pricing and how you do business. That's, of course, even more heightened in transactions with lower tax jurisdictions versus high jurisdictions. So transfer pricing is not just about compliance and managing risk. What's important to understand that there's also business model optimization opportunities if you do your transfer pricing correct, if you plan your models correct. To do that, you need to ensure you have the appropriate substance to underpin your models, and you need to have the right belts and bases framework in place. But it's how you do business internationally or cross-border and how you structure that. And so long as you comply with the rules in terms of substance and what's happening on the ground, there is opportunities to ensure that you're increasing efficiencies in supply chain or managing your effective tax risk quite carefully. So global TP trends, as we mentioned, there are external forces and internal forces that kind of play into the cards here. There's a new legislation globally and the OECD standards. Even this year, they released a brand new set of OECD updated rules. What we're seeing is the upskilling of tax authority and an increased audit focus. Tax authorities think that there is big money in transfer pricing, particularly in Africa. They feel like that they have not looked at transfer pricing closely enough ever, and now they're investing in the skills to be able to appropriately audit transfer pricing. We see the African tax authorities work very closely with ATAF, the African Tax Administration Forum, in terms of upskilling, in terms of getting their laws even correct in the outset. And some of the African tax authorities work together, and they even work with certain European tax authorities to try to help them get up to speed with the new legislation and get those resources in place. There is an increased focus globally on tax transparency. So globally, transfer pricing covers three layers: the country by country, the master file, and the local file. Currently, Mozambique is only focused really on the local transfer pricing file. So at the minute, we have a slightly lower compliance obligation than most of the other countries in the world. However, that local file is, of course, the most critical file from a Mozambique perspective because it tells how the Mozambican entity does its transactions. So it's more relevant. TP disputes, of course, are on the rise. These are billions of rand. I'm not sure quite how to translate that into Mozambique and Metical, Luis, but I'm sure you can. And there's keen political interest. Even, I mean, the Irish budget, a long way away from you, but I'm from Ireland, was released yesterday. And of course, transfer pricing pops up there as well. So there is no global budget release where transfer pricing is not measured at this point in any jurisdiction in the world. It is just up there as super important in terms of what's the tax legislation in the countries and how we do international business. From an internal perspective, of course, what does this mean for you? You've got this increased compliance burden. It's a new type of tax that you may most likely have never had to deal with before or not have transfer pricing documentation in place before. So of course that costs money, time and resources. And it's quite a comprehensive exercise. So it's not just a tick the box exercise. There is quite a bit of work required to put into it. So businesses in Mozambique need to think, okay, how are we going to do this? Are we going to upskill some of our people in-house? How are we going to be able to identify when transfer pricing is important to our business? All of those types of things. There's new questions we need to be asking ourselves. Certain businesses are actually doing a lot of restructuring over the last number of years and rethinking how they actually do business. So assessing, is what we do actually aligned with new global best practices and local and international law? We have seen that businesses have to adopt, either increase substance in certain jurisdictions, change remuneration models by taking into account all of this new slate of legislation and guidance that's been issued. TP, back when I started in Johannesburg, was more of a theoretical exercise. People would do the reports to do compliant, and they would put those reports in their beautiful bookcases. But now that's not good enough. Now you actually have to evidence that you've implemented these beautiful reports into your business. Implementation and monitoring, as I mentioned, is becoming key, because every year you have to evidence how you're operating, and you have to essentially the financial data and your legal agreements and your transfer pricing documentation, various forms of information that govern transfer pricing, are assessed by the tax authorities. So now you need to make sure that they're all tying up and making sense. So we've really gone from a lot of both external, internal forces heading down on us to say, look, it's time to take transfer pricing seriously, because the tax authorities are. So of course, as taxpayers, we don't have much choice at the end of the day. Some of the low-hanging fruit in terms of transfer pricing are transactions which relate to intellectual property. This is because often intellectual property is paid for through a royalty as a percentage of revenue. So they can be very high value transactions. And previously, groups did this based on legal ownership of the IP. So globally, not just in Africa, IP was never carefully enough analysed, and there was a whole action in the BEPS action plan around IP. It's not been done correctly. Businesses struggle to identify if there's IP or not in the business. How do we classify that from a transfer pricing perspective? And because they tend to be high value transactions, there's a big focus around that. A couple like large multinationals like Nike and Google, places where it's obvious you've got a brand name, have been challenged by tax authorities. But IP is more complex than that. There's soft intangibles. It's not just the legally owned intangibles. It can be know-how and processing. It's a very complicated area. So it's low-hanging fruit in terms of the tax authorities are asking questions there that often the businesses themselves currently don't know how to answer. Financial transactions, we had a new set of OECD rules on financial transactions that have been, some parts have been adopted in Africa. So looking at interest-free loans, for example, and certain African jurisdictions, if they're an outbound interest-free loan looking to deem withholding tax on it, any jurisdiction where we're paying money, for Mozambique, it's more usually when we're paying outbound, and that entity that we're paying to doesn't have appropriate substance or sits in a low tax jurisdictions. Loss-making entities generally. So if you're transacting, and normally this is relating to goods, if you're transacting with your major transactions are with a third party, but you continue to make losses, this is probably one of the easiest place for a tax authority to challenge you. The simple premise is that a third party wouldn't continue doing business at a loss for this long. So you need to be able to explain this. Of course, the COVID environment and the challenging economic factors that have impacted Mozambique makes this much more complex. So generally, our transfer pricing documentation will require us to explain very carefully any losses we made or any fluctuations in the profitability, to essentially show that it's not because of inappropriate transfer pricing practices, but rather as a result of wider and economic commercial factors impacting your business. Without having that type of narrative, particularly around COVID, which has really severely impacted, of course, businesses in the years that the Mozambican tax authorities are currently looking at, you need to have that narrative in your documentation, or it is essentially very easy for a tax authority to challenge you. And the onus is on the taxpayer, remember. We've got to prove it's arm's length. And if we don't prove that, the tax authority obviously has a much wider scope in terms of challenging and auditing us. On the same line of thought, it's entities with significant profit fluctuations. Why are you making a loss this year and a massive profit the other year? Back-to-back transactions. So that can mean where we have a back-to-back or artificial transaction where it's going through one entity, but it's actually originally sourced from another entity. These type of tricky transactions normally have to be untackled through the transfer pricing process. The obvious one is high value transactions. If your business has high value related party transactions, it is obviously the tax authorities are going to follow the money. They're going to focus on the higher value transactions. That's often, as we said, goods, royalties, and loans. Services are very easy to challenge, and sometimes the less experienced tax authorities focus quite a lot on services. What's important to note that it's not just the plus. You know, we're paying a cost plus 5, so the 5% is fine to a related party. It's actually, is the cost base itself calculated correctly? Because obviously the cost base itself is significantly higher than the 5% that you apply on top of it. Domestic transactions, as we mentioned, are also being focused on in Mozambique. And if your core business is related party, so if a significant amount of your revenue or expenses relates to related party transactions of any type, you are, on the high likely of being looked at by a tax authority. People are going to care about you much more. There's a whole chapter in the OECD guidelines about restructuring. If there is ever a merger, an acquisition, or a restructuring within a group, this should always trigger a transfer pricing review, because there tends to be new transactions, changes to the model, reshifting of substance and functions within the group. So they've recently been tackling, because they're easy to identify, especially for big players. If you've just restructured, it's public information. So then they're going to say, have a look. The most important thing, of course, is if you've no documentation, you have no defense. And you're certainly starting at a far behind the scenes. A quick overview of the transfer pricing life cycle. So first of all, of course, we have to decide, what is our transfer pricing policies? What's our plan? What transactions do we have in place? Try to understand what's happening there. We then have to document and benchmark our related party transactions. And then the third area where we all hope to stay away from is dispute resolution and controversy management. Along the lifeline of transfer pricing, we have what's called operational transfer pricing. And that's basically what the business does. It's how do they operationalize this transfer pricing into their business? How do they make sure that if there's a new transaction with an entity in Kenya, that transfer pricing is being thought about, that it's being flagged, that it's being compliant with the group's transfer pricing policies or the local entity's transfer pricing policies. So this goes around implementation and monitoring. As we said, it's not a paper exercise. These policies have to be practically implemented into your business on a day-to-day basis. Now I'm going to hand over to my colleague Luis to really dig into the TP Mozambican transfer pricing rules with you. Over to you, Luis.
Thank you, Cabrini. So first of all, we need to understand how the transfer pricing here in Mozambique started. So we will start from the applicable legislation and effective date of the transfer pricing regime here in Mozambique. Considerations on the transfer pricing was not new here in Mozambique, because first we have on the corporate income tax code on Article 49 that establishes rules in respect of the transfer pricing, where including the possibility for the tax authorities to make any corrections necessary to determine the taxable, the person were or not subject to CIT. So the TPR regime applies to individuals and companies resident or domiciled in Mozambique, and to permanent establishment companies, non-resident in Mozambique, that conduct transactions and associate with non-resident and resident company, as well as with other personals. So the transfer pricing regime develops and establishes the transfer pricing rule provided in income tax code. So the effective date of application of the TP rules in Mozambique is January 1, 2018. So by December 22, we will reach 5 years of effectiveness. So as Cabrini said before, the regime follows the mixed approach of OECD TP guidelines for multinational enterprises and tax administrations, and also follows the guidelines from the UN practical manuals on transfer price development countries. Of course, that when we are looking to the how we structure our documentation and how we document transactions on the TP files, we should first consider the local rules after the applying the other rules around. Of course, we need to take into consideration first the local Mozambican rules, and then we need to explore after that the other rules. So from the scope of application and the general rules on the TP regime in Mozambique, that applies to the taxable persons of corporate income tax and individual income tax who carry out transactions with resident and non-resident related parties. Here we are saying that the transactions involved on the transfer pricing regime in Mozambique are domestic and cross-border transactions with related parties. And those, the scope of application also is extended to the permanent establishment, transacting in different ways with related parties. So there is no threshold in relation to the amount of the transactions, domestic or cross-border transactions. But there is a threshold in order to apply the TP rules to a corporate income tax in a corporate income person and an individual income person. So there is a threshold of 2,500,000 meticash of revenues equals of sales plus other incomes in relation to the previous years of application. How can we treat that? We are saying that if we are in 2022, so we will need to look at the financials of 2021 and look at the revenue of the company that we are analyzing and see that if the revenue of sales plus other incomes are equal or above 2,500,000 meticash, right? So the principle is the global principle of the arm's length principle. So in transactions between corporate income tax and individual income taxpayer and permanent establishment, so which there is a special relationship, terms and conditions shall be agreed, accepted, and practices substantially identical to those which will normally be agreed, accepted, and practiced between independent entities. That's arm's length principle, right? So for the purpose of transfer pricing in Mozambique, we need to look at how we consider each other as a related party, or how is related party is being considered between the entities. So an entity is deemed to be related to another based on the TP rules in Mozambique if the entity directly or indirectly control or is controlled or is under common control of the same entity. What we are saying that if a foreign hold company holds a subsidiary here in Mozambique or holds or operates a branch here in Mozambique, that will fall under this control or under control, common control of the same entity. Has an interest in the company that grants a significant influence or has joint control over the entity, is an associate or as a joint venture of the other entity, is a member of the management of the other entity or its main office, or manage a post-employment benefit for the other entity's employees. So there is no definition of the concept of significant influence. However, with this new TP regime, is now specifically regulated in Mozambique with the definition and examples regarding when a company exercises a significant influence over the other company's management decision. So that's considered that there is a significant influence over the management decision of the other company, particularly in the following scenarios. So a company and the holders of its capital, for example, or their spouses or relatives in the ascendant or descendant lines, directly or indirectly hold a share of no less than 10% of the capital or voting rights. So entities in which the same capital holders or their spouses or relatives in the ascendant or descendant lines directly or indirectly hold a share of no less than 10% of the capital of voting rights. A company and the members of statutory bodies, companies in which the majority of members of statutory body, companies connected by subordinating agreement, companies that are in controlling positions, or companies between which due to commercial, financial, professionals, or legal relations between them directly or indirectly established or conducted situations or dependent occurred in the exercise of their activity, right? So when we analyzing the transactions between the related parties, we should take into consideration all of that aspects in related to how we consider as connected persons, as related parties, and how they each other can each other exercise a significant influence on each other, right? So in addition to that, Cabrini, can you please? Okay. So the adjustments to the taxable income that mentioned the TP rules is whenever the terms and conditions of a related party transaction involves a taxpayer and an entity non-resident in Mozambique or in Mozambique differs from those which would normally be agreed. So arm's length principle. So what we should do on our corporate income tax annual tax, we should perform a positive correction corresponding to the tax effects attributable that deviation so that the taxable profit determined is not different from that found in the absence of special relation. So what we should consider when we are preparing our corporate income tax return, Modelo 22, Form 22 here in Mozambique. So we should consider all the deviations in regards to the transactions between related parties if they are not on arm's length, right? So the taxpayer shall have for the determination of terms and conditions which would normally be agreed, accepted, or practiced between independent entities. The most appropriate method for each transaction or series of transactions in accordance with the principle of full competition during the financial year by good, right, or services. Here, we are saying that when we are assessing the transfer pricing for each transaction, we should consider the best methods in order to prove that that transaction is on the arm's length, in order to test that transaction. So if the comparable price determined by one of the transfer pricing methods is higher than the prices shown in the import or purchase documents, the amount of the cost or expense recognized in accordance with those documents shall prevail and no compensation shall be payable between them, meaning that when we are analyzing in the importation or purchase documents, so as long as we can prove that occurred, as long as that the price shown in that document and the expense recognized in accordance with those documents, that should be sufficient in order to prove that there is an arm's length between that transaction, right? So The methods of determination of transfer pricing here in Mozambique are basically all aligned on the OECD and UN practical guidelines. So the methods used for the necessary corrections for the determination of the taxable profit are controlled price method, the resale price method, and the cost plus method. And also we have the transactional profit split method, transactional net margin method. All other method appropriate to the facts and the specific circumstances of each transaction, which means that the regime opens a window for the taxpayer in order to prove based on other methods of determination of transfer pricing appropriately tested in order to prove that the transactions are on arm's length. So what are the TP documentation requirements here in Mozambique? So in order to comply with the obligations, the taxpayer must obtain and produce and maintain a transfer pricing file with the following information. Note that for the taxpayer to prepare the transfer pricing file, its first requirement is that on the previous year they reach a sales above or equal to 2,500,000 meticais, right? And they had transactions with resident and non-resident entities. So the local files is the only file that is obliged here in Mozambique, besides other files that are obliged based on the OECD and UN practical guidance. So the file should contain the following information: description and characterization of the situation of special relations, where we explain how we determine that those transactions that we going to prove that we're going to test are on arm's length. The entities involved on those transactions should be between connected persons, right? Characterization of the activity carried out by the taxpayer and related entities with which he carries out transactions, and details of the transactions carried out, where we go through the transaction and see what was the main purpose of the transactions, which was the beneficiaries of the transactions, and so on. Detailed identification of the goods, rights, or services that are subject of the related operations, and of the terms and conditions established when such information does not result from the contracts concluded. So we need to access, we need to put on the we need to document exactly what was transacted during a financial year. Guidelines on the implementation of the transfer pricing policy. That's a new word. That's something critical, because after the preparation of the TP file, the tax authority might have a look if effectively the taxpayer implement the transfer pricing that was documented or that is in place in their transactions, right? So other requirements include the details of analysis carried out to assess the degree of comparability between related parties and between the companies involved in them, including functional and financial analysis and adjustments made to eliminate existing difference. That's specifically and aligned with the international practice, where we should in order to test a transactions, we need to have a fair and circumstances and comparabilities between related and non-related transactions, right? Although it's not required to submit the transfer pricing file here in Mozambique along with the annual corporate income tax return, The file should be prepared until the deadline for submission of the AFS or the statutory accounts, or we can say the accounting and tax return. By the end of the 6 months following the year end, for the taxpayer who the year end doesn't match with its civil year, that is December, and presented to the Mozambique tax authorities upon request, right? Although that the transfer pricing file is not required to be submitted here in Mozambique, there is a transfer pricing return that was approved in August 2020, which is part of the annual statutory return that that must be submitted until the June of the following year of normal taxpayer year end, and or until the end of 6 months following the year of the end of taxpayers. Taxpayers obliged to comply with the local TP rules must disclose in the TP return the amount of transactions, goods and services with related parties, resident or non-resident, including loans received and costs recharged. So that part of filing the TP return should be aligned or with the TP file that must be prepared along with the transactions between related parties. So if a tax authority look at the TP return that will be submitted, they will need to see if that is aligned with the TP file that should be prepared and should be in place by every taxpayer until the end of the 6 months or until June of the following year. In addition, taxpayers should indicate the TP method used, whether there is an excess of interest under TIN capitalization, and whether the company has the TP documentation in place or not. Here, when we are talking about the excess of interest under TIN capitalization, we are talking about of loans between related parties. Okay. Go on. So penalties for non-compliance of the TP regime here in Mozambique. The first penalty for non-compliance is the adjustments to the taxable income, with the fines that can range from the amount due to its double, with a maximum limit of 2.5 million meticals, that's around 43,000 US dollars. The non-presentation of the TP documentation when requested by tax authorities, fines that range from 6,000 meticals to 2 million meticals. The non-submission of TP return within deadlines, there are fines that range from 6,000 to 130,000 meticals. Omissions or inaccuracy in TP return or in TP documentation, fines that range from 13,000 to 700,000 meticals. So these penalties for non-compliance are general penalties under the local legislation. And based on the TP rule, there is nothing in relation of penalties that are for non-compliance. So these penalties that we are bringing here are general penalties that are stated on the local legislation, right? So what are the TP issues trending here in Mozambique? In terms of what we see here in Mozambique, let's say that we need to take into consideration, first of all, what kind of transactions we might see here. We can see here in Mozambique between related parties. Most of the transactions are related to management fees, to technical assistance and interest on loans between related parties, and import or export of goods. Most of the times, commodities. We know that Mozambique has a lot of exploration, and the commodities are something that should be under consideration during the analysis of transfer pricing. So we do not anticipate.
Sorry, Luis, just to add on that commodities is one of the areas across Africa that is being challenged the most on transfer pricing disputes, because the export of commodities out is an extremely common transaction out of Africa. It's also extremely high value transaction. So that's probably across Africa the highest value transaction, and it is the most common one that the African tax authorities are looking. So we can expect, now that the 5 years, right, the Mozambique tax authority have said the legislation has been here now for long enough. We can expect this area, now that they start to monitor and implement who's done what on transfer pricing, we can expect this area to be challenged. Thanks, Luis.
Yeah. Yes, sure. So the regime here in Mozambique has a specific section where it's talked about commodities. A specific section where the commodities is treated under consideration for the transfer pricing purposes. So it will be an attention for the tax authorities for the next years by now. Okay. So here in Mozambique, we do not anticipate audits to based on the industries per se, but we know that the tax authorities to focus on entities that have the following situation to be the first ones to be audited: loss-making entities. We know that a lot of foreign companies has subsidiaries or branches established here in Mozambique that are presenting during more than 5-10 years losses. So that should consider, that should be any advice to those companies in order to comply with the transfer pricing rule. Companies with significant profit fluctuations, high value transactions, we talked about commodities now, and royalties, that are also an important transaction that we should take into consideration. And core business is related parties, significant personal revenue, Cabrini talked about that. Entities with back-to-back transactions, related parties in the low tax jurisdictions. Please note that any of these situations assume that entity is liable to prepare and submit a return and prepare a TP dossier. Remember that no transfer pricing file, no defense should be taken into consideration by the tax authorities, right? We know that Mozambique is not part of the OECD. It has been practice of the tax authority to follow guidelines and trends from these organizations and guidelines from comparative jurisdiction, such as Portuguese, for example, that follows also the OECD and international guidelines, and also the other international guidelines. Of course, that the best defense will always be documentation in place, but not only having the file ready for submission in case of request. I'm facing here in Mozambique most of the clients that is trying to reach our services is that they only want to prepare the documentation when the tax authorities ask for it. So normally the tax authority asks for a period of 15 days in order to present most of the documentations, but they normally what the clients here in Mozambique is saying is that we will only need your help in order to prepare that file when the tax authority requests to us. And we will use, for example, a master file used by a foreign holding company that was prepared there. Of course, we can have a base in order to compile the TP file using the master file prepared by the holding company, But we need to make sure that that master file is aligned with the local rules first, and then if they follow first the local rules, okay? So even though having the documentation in place on time, it's a self-defense where the taxpayer are more prepared in order to justify all the related party transactions and all the tested transactions that are on arm's length. So increasing TP-related tax authority queries and audit particulars around key Mozambique industries and large taxpayers. We are talking about those companies who transact with commodities, and those companies who transact with most of the time with other goods and royalties. The taxpayer must be aware that tax audit can be done for the last 5 years. Well, now we are saying that since the effective date of the TP regime here in Mozambique, we are reaching 5 years by December 2022. So it meaning that we need to acknowledge all of our taxpayers here in Mozambique and our clients in order to get ready for the tax authority to appoint this matter on the tax auditors. It's important to keep in mind that even in sequences of application of reduced tax rate under a double taxation agreement, or for example, on the loan repayments, including interest, dividends, and services, also applicable to management fees, royalties, and similar, the arm's length principle should be applied in order to avoid any TP adjustment by the tax authority. So also there is the predatory approach by the tax authority to treat as loan contracted by non-resident and residents all the supply of goods and services that have been delivered or rendered without payment for a period of 2 years. Hence, a TP arm's length should also be taken into consideration. So this means that even though no payments of services or goods to non-residents or residents, that should be deemed for TP consideration here in Mozambique, right? For payments to related parties in the law jurisdictions, the authorities will need to be satisfied that the payment was genuine and reasonable, applicable to the jurisdictions where the corporate income tax rate is less than 19.2%. Okay. So before I finish and pass through Cabrini, I would like to talk about how. So we are on 2022 financial year by now, but we have seen a lot of companies here in Mozambique that do not comply with this TP rules since the effective date 2018. So we normally advise to our clients to manage to have the TP file in place and guarantee that all the transactions between related parties are tested and are in compliance with the rules, right? So that's an attention, for example, for now, for this financial year 2022, that ends in December. So the taxpayer should prepare the tax file and have in place by June next year, 2023, and submit a TP return by the same day, by the same time. Okay. So I think that's all for me. Note that we didn't dig for specific technical issues on the TP regime, but the main consideration that should be taken into alert for all the participants and for all the taxpayers that should be taken into consideration on their transactions. Thank you.
Super. Thank you, Luis. Appreciate that. So just to wrap up, what should you do in next steps? This might seem like a lot. In Mozambique, as Luis mentioned, we're behind the times in terms of getting compliant from a transfer pricing perspective. So the very first thing is to understand if you meet the 2.5 meticals revenue. Right? If you do that and you have any type of cross-border or domestic related party transaction, you have a compliance obligation for the last 5 years. We expect the tax authorities to start auditing that now because they don't want to lose out on revenue because the period for audit has run. So we expect this to be on the agenda. Transfer pricing is time consuming, particularly the first time that you prepare your documentation. So check what you have and understand what is required in your business as a key priority. Then we suggest is when you understand what you have, understand what are the gaps and the pitfalls. Do you have a transfer pricing documentation? Do you have to submit your declaration? Do you have benchmarking studies for your transactions? Do you have appropriate compliant documentation in place? Group documentation doesn't cut it when it comes to local Mozambique requirements. You need to ensure that it's adapted for local legislative purposes. Then need to design a strategy to manage any risks you identify and ensure that there's a robust, compliant TP framework in place. Just because Mozambican tax authorities have not started, detailed auditing every taxpayer yet, now's the time, and we expect this to happen. Then we have to implement and monitor TP, ensure that we're ingraining our transfer pricing practices in the business. As we say, transfer pricing, it won't go away. It's more and more focused by the tax authorities. Commodities are key. We're currently working on a commodities dispute in the number of billion of rand value, and it's open. There's about 6 different years that we're looking at there. So the penalties is, let's say is the adjustment to the tax base. If you're shown that you're selling commodities, for example, under value, there's an adjustment to your tax base of what that undervalue is, plus all the penalties. The compliance penalties are very, very minor compared to the actual adjustment that may potentially a tax authority may try to incur on your business. So how can we help? Regan van Rooy offers a full suite of transfer pricing services, from starting from scratch to ensure that your transfer pricing policies are okay, looking at business model optimization, the documentation compliance, the benchmarking studies, and of course, the one everybody wants to avoid is controversy management. So I would like to thank everybody for joining us today. And Luis, thank you very much. Luis and I've worked together for a number of years, and Luis, being local in Mozambique, offers a great insight to what's happening locally. We appreciate your time in joining us on this webinar today, and thank you everyone else for joining. Please feel free to reach out to us if you have any questions whatsoever, and we'd be delighted to help you navigate this transfer pricing environment. Thanks again.
Thank you, everyone, and thanks for joining us.
Thank you. Thanks.